All right, folks, let's do it. Good morning, one and all. Welcome to the Street's opening bell here from Post 35 on the floor of the New York Stock Exchange. Today is Wednesday, September 21st, National Mini Golf Day. That's true. Did you know today is the day we celebrate mini golf? Well, we do. I'm your host, JD Durkin. Bell rung just moments ago on the floor of the Stock Exchange by Coordinating Minister for Maritime and Investment Affairs of Indonesia. A lot of Indonesian flags here in the NYSE to celebrate this morning. A quick check of the big board just a few moments into this trading Wednesday, and there is green on the board. That's similar for the small cap stocks as well as for the Dow, which right now is up 0.3 of a percentage point, about 100 points. That may not be the story all day long, but it's certainly the story that we will most closely be following. Of course, everyone on Fed watch on this Wednesday morning as investors wait to hear the fate of the Fed funds rate from, of course, Jay Powell. We are expecting a press conference in the 2 o'clock hour Eastern time later on this afternoon to learn more about the rates for the months ahead. And of course, the likeliest outcome expected to be a third consecutive 3/4 point rate hike. Let's take a look at what's on tap for this morning's broadcast. Of course, we will talk all about Jay Powell's big day and what both his decision and his press conference may mean for today's session on Wall Street, and quite honestly, probably the sessions in the near-term future as well. Plus, demand for mortgages has risen for the first time in 6 weeks. What this application volume data means for you. All this, of course, despite a raise in interest rates. For those stories and so much more, let's now bring in our senior editor and markets correspondent, Mr. Martin Baccardax. Martin, good morning to you here, my friend. So I think in good faith that the question that's top of mind for everyone who follows the major market indices very closely, inflation has been hot. How hawkish will Powell be?
This is the question that everybody wants the answer to. We'll get it at 2:30 this afternoon when he speaks to the media in Washington. But prior to that, we're going to get the assumption of hawkishness with, as you teed up, the third consecutive 75 basis point rate hike. That will take the key Fed funds rate to a range of between 3 and 3.25%. It will mark the third consecutive, and it will probably be another step on the march to a Fed funds rate that will get to around 4.25% in early February. Now, Powell has told us that taming inflation is at this point the most significant challenge of the Fed's dual mandate, which is for full employment and price stability. They're reasonably comfortable with the situation in the labor market. We're not at full employment, of course, but we have improved significantly since the pandemic lows. Price stability remains the trickier of the two. And he has said it's going to require some pain for the U.S. economy in order to make sure that inflation comes back closer to the Fed's 2% target. We're a long way from there, and that might mean a lot of pain until we actually arrive at that destination. But Powell doesn't seem prepared to blink at the moment, and therefore we can expect something along the lines of more hawkish rhetoric when he does speak to the media, and that will, of course, elicit accelerated bets on rate hikes going into the end of the year.
So, Martin, to me, it sounds as if you are expecting Powell to largely reiterate what he said at Jackson Hole. You used the word pain because Powell used the word pain. Has there been any sense in terms of new data since the Jackson Hole speech a few weeks ago that might make you think maybe the rhetoric and the things he says might be a bit different, or are you largely expecting this to be right in line with where he was?
I suspect that the hotter than expected reading we had for inflation for last month was part and parcel of why the Fed would like to remain as hawkish as they are. We had headline inflation accelerating to 8.3%. The assumption was the core was going to peel back a bit, but that didn't happen either. And when I talk about core, what I mean is inflation which strips away food and energy prices, because of course we know that those are gamboling at rates that we haven't seen in many, many decades, and they aren't really impacted by anything that the Fed does with respect to broader interest rates. But the core prices suggest that inflation has embedded itself into the economy, and that's precisely what the Fed does not want to see. Now, the caveat to that is the Fed's preferred measure of inflation is actually not the CPI data that we most pay attention to. It's something called the PCE price index, most specifically the core PCE price index. That is a way that the Fed can look at inflation dynamics, strip away components of it that might be seeing expressed or increased demand as a result of strange things in the supply chain or changing consumer habits, and have a smoother look at the inflation pump. The PCE price index at a core basis has been falling since February. It's on a decline now that is in its 7th consecutive month. Typically, the Fed will stop raising rates after 6 months of decline for the core PCE price index. And they haven't done that yet, which tells me they're a little bit more worried about two things. Firstly, that core prices have embedded into the economy, as we discussed. But secondly, they don't want to make the mistake that they made last year, where the assumption was that inflation was going to be transitory, it was going to roll off very quickly, and of course, that was a bit of egg on the face. And let's be honest, it was an apology that Fed Chairman Jerome Powell made of his own volition, and he took responsibility for it. But the Fed doesn't want to make a similar mistake this time, which is why they are going to have a more hawkish tilt, even if some of the data suggests that inflation pressures are mitigating and will do so arithmetically over the next few months.
I wonder how hawkish that tilt may be, Martin. I want to get your perspective on something, a comment that really made a lot of headlines yesterday. This comes from Michael Schumacher from Wells Fargo, essentially making the argument here to say, if we know where the terminal rate is going, right, which is something you and I have talked about, you've done an excellent job in our morning broadcast helping us understand that it might be less important the pace with which we get there. What matters is the destination here. And the argument here from Wells Fargo is to say, why not rip this Band-Aid off? Forget the talk of 75 or even 100 basis points. Let's go as high as 150 if we know where the end destination here is. How unpopular a view is that, given that we can probably surmise what investors would have in store if Jay Powell were to do something quite that drastic?
Well, I was really struck by the note, actually, and I thought 150 basis points might have been a bit of an exaggeration from the analyst's part in order to get some attention for a note that would typically get lost in the shuffle of research papers heading into a Fed decision. We all write about it. It's very difficult for people to read it with any great specificity. So the fact that you put 150 basis point rate hike out there certainly engages the thought process and gives you a little bit more attention than you might necessarily sort of achieve. That said, the point that he makes is an interesting one in the sense that, yes, if we are going to get to that terminal destination, which we've all agreed, we might as well do it quickly. I'm not sure I necessarily agree with that because for the most part, it needs to be remembered that the Fed has to have the cooperation of the policy transmission mechanism. In other words, they need the banks on side in order to make sure that they're increasing credit levels into the economy. That's the only way it grows, and therefore are not spooked by some kind of decision that the Fed would take, which banks might see as indicative of a nasty surprise that the officials see that the banks and lenders do not. So ultimately, the dislocation that would come from such a significant rate hike, the biggest since 1980, would be so significant as to actually undermine the tactic that the Wells Fargo analyst was sort of articulating, and that's to rip the Band-Aid off. I don't disagree that we're going to get to the terminal Fed funds rate that mostly were agreed upon, again, barring some nasty surprise. But I don't necessarily think that the objective of doing it quickly is the best one because of the dislocation, the disruption it would cause, and therefore the pullback in credit generation, which would almost guarantee that the economy slips into recession and therefore destroy the soft landing engineer that the Fed would like to see.
And what is that peak for you, Martin? I know you follow CME Group's FedWatch very closely. Are we still expecting about 4.5 when all's said and done?
It seems to be the balance of probability at between 4.25% and 4.5%. It might be a little bit higher than that. My suspicion is that if we do see the roll-off in core inflation in the next few months, that terminal rate might come down a bit. It's still probably going to be north of 4% and then remain there for some time. I think that's the second derivative of the conversation that hasn't been dug into too deeply yet. And that's about the fact that, yes, we will get a Fed pause at some stage, but at how long a time frame will the Fed stay at that interest rate level? That may prove to be more important in terms of company executives planning their investments and cost cutting and everything else into the next couple of years, investors making decisions on capital allocation and ultimately the path of U.S. and global economic growth. So ultimately, we're going through the first derivative right now. How do we get there? The second is going to be how long do we stay there? And we really won't know the answer to that until we get a bit more inflation data. And we've got several months of it now before we really have to come to that conclusion in early February.
Yeah, you and I have talked about that someone like Jay Powell has various economic levers to use at his disposal, but the words he uses can launch 1,000 headlines. And I'm sure this will be a day where that will very much be in line. So I'm curious from your perspective, Martin, aside from the announcement itself, the data and especially the forecasts, we'll be listening for the words that Powell uses. I wonder if there's other language that he might use to wrap around the announcement to perhaps take some of the edge off for investors. Will there be any of those key phrases that that may or may not make headlines that you will be closely listening to later on this afternoon?
Yes, absolutely. I think we're going to pay attention to the adjectives that the Fed chair decides to deploy when he talks about the price increase pressures, the rates of inflation, the rate of change of inflation, and ultimately how and when and to what degree the Fed will use the tools in order to mitigate it. So if he is using words like significantly and having those kinds of effects on job growth and price pressures and everything else like that, investors are going to see it as hawkish. If he is able to dial that back a little bit, then we might have it sort of expressed or accepted by the markets in a more dovish fashion. I'd still put my money on something that tilts to the hawkish end, but I have always been impressed with the way that Chairman Powell has been able to communicate his objectives to the media, through the media, and to the marketplace in general. I think he's an excellent communicator. I think, like most Fed chairs, he's been plain spoken about what it is that the Fed would like to accomplish and how it would like to go about it. It doesn't obviously satisfy everyone, and markets can be incredibly impatient. But I really do believe that the task of explaining exceedingly complicated monetary policy to the nation at large is one that's probably the most difficult in all of the senior positions in the U.S. government. And it has always been impressive to me to watch people like him, Janet Yellen, etc., perform that task. And irrespective of what he has to say today, I am always in awe when I watch these press conferences, because he's able to take questions so calmly, he answers very clearly, and he really does try to sort of structure the Fed's position and response as he does so. Not an easy thing to do.
Yeah, of course, largely what the Fed is trying to do here is to limit the purchasing power of day-to-day Americans. And Martin, before we move on to other topics, including mortgages here, I do want to get your perspective on what ultimately you think this means for the average viewer who's watching. I think largely we have people here at the street who have portfolios. They're watching through the lens of investment, but we all have purchasing power to some degree, and those numbers may be impacted as this federal benchmark rate moves on. Give us the 10,000-foot view about what this means, you think, for the average American consumer and the average American spender for the months ahead.
No, I think it's significant because, of course, consumer spending drives about 2/3 of U.S. economic growth. So there's a lot to play for in terms of being able to engineer that soft landing and ensuring that the economy doesn't slip into recession in a way that would be predicated by a blunting of consumer demand and discretionary spending by rates that are simply too high. Gratefully, despite the fact that we're on this accelerated tightening phase, the Fed is starting from a low base, almost the lowest in history. So whilst we are seeing increased spending costs and therefore, as a result, reduced purchasing power, it's not to the degree that we saw during hyperinflation in the 1970s, and Americans do seem to be weathering it reasonably well. Largely because the job market has been in a resurgence. People have a little bit more power in terms of influencing wage increases and indeed salary increases by moving jobs and things like that. But ultimately, this is going to flow through into the housing market, into consumer spending, into consumer borrowing, and have significant implications for not only what we do from an economic perspective, but also from a personal one as well. Because ultimately, the Fed rates are benchmarked against, or excuse me, what I should say is that U.S. Treasury bond yields are benchmarked against what the Fed is going to do and what it has already done. And most of our consumer borrowing rates will lever off of U.S. Treasury bond rates, particularly 30-year mortgages. That's the most important. That connective tissue lies right from a 10-year bond yield to the 30-year fixed rate. So that is probably the most significant change that we'll see, and probably the most visceral in terms of ultimate impact. But if you're borrowing any kind of money, you're going to see an increased cost as a result.
And Martin, I do want to give our live viewers just an update to get a sense on what investors, or how investors are reacting about 18 minutes or so into the start of the trade session. We do have green on the board, and that's true for the Dow, the S&P, the NASDAQ up 0.4 right now out of the Dow 30, all but 4 stocks currently trading in the green. Martin, to this point, not to get too into the weeds of the immediacy of intraday trading here, but are you surprised to see at least even the fractional green on the board as Wall Street does brace for what Mr. Powell will be saying in a few hours' time, or is this largely in line with your expectation pre-announcement?
A little bit of both, to be honest, and I know that's a bit of a waffle answer, but what I would say is that the anticipation of the 75 basis point rate hike has been baked into the market for quite some time now. And what we did see overnight was a pullback in Treasury bond yields as a result of some safe haven trading. Bond yields tend to move, well, they don't tend to move, they absolutely arithmetically move inversely to prices. So if you are an investor overseas, you're hearing the rhetoric from Vladimir Putin about the amplification of military involvement in the Ukraine, you're going to go into a safe haven asset. That's generally the US dollar or US Treasury bonds. The prices rise, the yields decline. That adds a little bit more impetus into early stock prices here in the United States. But it also reflects the fact that, again, barring a nasty surprise, we're probably looking at 75 and reiterated hawkish rhetoric from Chairman Powell. There's no need to actually sell that if you are an investor because you've been anticipating it for several weeks, and therefore you might actually get a pop higher if that's what he delivered. Where we'll see market volatility is if Fed Chair Powell deviates from that expectation with a smaller than expected rate hike, or with a rate hike and a significantly increased rhetoric in terms of hawkishness, or indeed a larger rate hike. If we get to 75 and the anticipated language that we're looking for, I would imagine stocks will grind higher, but not significantly.
Martin, I know we're journalists here. We're not in the business of advisement per se, but I am wondering for people that may be concerned here about an increase in rates and what this means in terms of volatility for the weeks and months ahead. Are there big overarching reasons for optimism that perhaps we haven't yet discussed for the next few months? I mean, we always talk before we know it, we'll be having this conversation. It'll be the heart of the holiday season. We traditionally have things like a Santa Claus rally and a bit of a pop to the indices late in the season. Is there a reason to have some forward-looking optimism regardless of an announcement today from the Fed?
I really think so. When you look at the performance of the U.S. economy, it has been incredibly resilient given everything that's been thrown at it over the past 2 to 2.5 years. I mean, you're talking about a pandemic. You're talking about a historic increase in domestic energy prices. You're talking about record high gas prices. You're talking about the fastest inflation in more than 4 decades. You're talking about generational changes in employment movements and the fact that people are simply not returning to the office in any way that even closely resembles the sort of action that we saw prior to the pandemic. Yet and still, the economy is holding up reasonably well. Economic activity indicators for the month of August were pretty solid. Consumer spending is holding its own, even with the increased prices. The job market has been tight and continues to be so. And we're looking at historically very low unemployment rates. So given all that, there is absolutely some reason for optimism. Company executives, they feel less so at the moment, because I do think they want to see some of these inflation pressures play themselves through, and supply chains are still an issue. That was something that was articulated by Ford only yesterday, and that elicited the biggest fall for that stock in about 10 years. So that's not to say that there isn't speed bumps along the way, but the path of the U.S. economy has been reasonably smooth, considering all of the things that we've just discussed. And that resilience, if anything else, is probably the most significant reason for optimism that I could find sitting here today.
Finally, on this point, Martin, we may have a lot of viewers who say, quite honestly, I know the headlines whenever Jay Powell has a press conference like this, but I haven't tuned in myself. What do you recommend to people if they want to follow along with the comments? Obviously, we at TheStreet.com will have all the breaking news, guidance, and a bit of perspective and context on what it means for investors' portfolios. But what do you advise people who say, hey, I actually kind of want to see some of this press conference myself? What should that type of investor know before maybe tuning in for the type of event that impacts them, but maybe they don't tune into all that often usually?
Yeah, I mean, ultimately, I would say to most people, and I think this is probably true for nearly the vast majority of people who are invested in the marketplace, it's not something that you want to trade upon today. There's simply too much volatility. There's too much money moving in either direction, and you can get crushed as a result. I think this is more of an indication. What you need to take away from the press conference today is an indication of where the Fed chair sees the interest rate path going forward and what he has to say about the broader economy. He is not going to sugarcoat it. If he sees weakness, he will say so. If he sees resilience and strength, he will do the same. So in some respects, this is a good way to get a sober, specific, and unbiased analysis of the U.S. economy, and that can be the framework for your investment decisions going forward. But to try and trade it on the way in or indeed on the way out today, tomorrow, or over the coming days, I think is just too risky a prospect. And I would simply just encourage people to watch, learn, and take the information on board before they make any active investment decision as a result.
Well, even if we still do have a few hours before we hear from Chairman Powell, there's no shortage of good information to get read up into ahead of the press conference this afternoon. I recommend people check out TheStreet.com. Martin, who, of course, I don't think ever sleeps, filed an awesome story this morning. The headline is Fed Preview, Powell's Soft Landing Plans Still Require Pain, to use the word of the chairman from a few weeks ago. More big rate hikes. A great deep dive to better understand the context of what we'll expect later on this afternoon. Martin, while I have you, I do want to talk about Mortgage Bankers Association and some and a bit of chatter early this morning in pre-market trading. Mortgage application volume increased last week, and that's the first time that has happened in about a month and a half. Martin, what is behind these numbers, and why is this so important?
Well, I think that number was an interesting one, JD, because it suggests to me that people are going to chase the market a little bit, in the sense that they see mortgage rates rising and they want to get in now if they have any hope of purchasing a home in and around their planned budget. So that would suggest to me that people jumped into the mortgage market, got their applications approved, and are now going to try to close a home before mortgage rates rise even further. And they did so again last week. They're up 23 basis points to 6.25%. That's the highest since October of 2008. You'll remember, JD, we talked about this last week. They bumped past 6% for the first time since 2008 as a result of the anticipated Fed increases. So it's becoming more expensive to buy a home, and there simply aren't that many on the market right now to bring prices at an equilibrium. So I would have seen the increase in applications as a way in which buyers feel they can finally lock in something, I wouldn't say cheap, but lower than it's going to be. We're probably going to add another point to point and a half on 30-year mortgage rates at least before the Fed is ready to pause on its interest rate path. So houses are going to get more expensive from a borrowing point of view, and because there aren't so many on the market to sell, the price is probably going to remain the same, and that's not the equation that you want to see if you are a buyer. But what has also been interesting for me, JD, is the fact that building permits for the month of September were down about 10% from the previous month, when they had fallen 6% in July. So home builders aren't looking to capitalize on what's happening in the house market, because they simply don't see the kind of demand that would justify putting the investment in and putting a spade into the ground to get a new project going. What they are doing, however, is building multifamily units, because they're seeing such an increase in rent payments month on month. Rents have skyrocketed this year as a result of the tightness in the housing market. So the smart money in construction has moved more towards multifamilies and apartment complexes and away from single family homes. And that, of course, is also impacting the amount of inventory that's on the U.S. housing market too. So all of that is a sort of very visceral connection between what the Fed does and the implications for the American consumer, because the housing market is usually the very first and most sensitive to react to interest rate changes.
I wonder, Martin, if the data gives us a bit of information about particular metro areas, cities, communities that might be seeing more demand than others, or the trends pretty spread out across the nation.
It's such a disparate housing market that it's very difficult. There are some numbers from an index called the Case-Shiller Home Price Index, which is lagged by a couple of months, but it gives details on various metropolitan locations around the country. That's not published today. And again, because it lags, it's not always an indicator that you can use with any sort of forward-looking depth. But what we are seeing certainly is the fact that areas around the country that have more robust labor markets tend to have housing markets that are indicative of economic strength. And it's areas in the country that are a little bit, I wouldn't say depressed, but where their job markets are a little bit more static. is where you're seeing declines in not only home prices, but more significant increases not only in borrowing costs, but in lending criteria. And that, of course, has a stalling effect on the housing market as well.
Yeah, absolutely. A really fascinating headline from the folks over at Redfin yesterday on this issue that they report a record share of home buyers are looking to relocate, and specifically they're driven by moving away from expensive coastal areas. Just talking anecdotally with friends and family here around New York City, that they say if this is the time that you're trying to get in, good luck. It is certainly very much a challenge. I know that's true for many communities around the country as well. Martin, let's do our rapid fire section, shall we?
Let's do it.
Pew, time for it. Okay, first up. Oh, yeah, we've been following this one. Number one, is gas about to get more expensive, Martin?
It bumped up a penny last night, JD, and that's the first time it's done so in 98 days, which is really quite something. We basically snapped the longest streak of daily declines for U.S. gas prices since 2005. They were moving downward for about 14 weeks now, and they bumped up last night again for that first time. Now, they're reasonably cheap. On a 6-month basis, we're down significantly, about 27% from the records that we reached in June, but we're still 15% higher than we were this time last year. So it's not exactly cheap to fill up your cars. We're seeing a bump higher in oil prices as a result of the rhetoric that we are hearing from Vladimir Putin and the situation that we're seeing militarily in the Ukraine. But China's economy is still kind of on its knees at the moment. They're the biggest energy importer, and therefore I don't think anybody's anticipating that crude prices are going to stay at these levels, and they'll probably drift lower into the end of the year. That will be good news for American gas purchasers. The second thing, JD, which is really interesting to me, summer gasoline is different to winter gasoline. The blends that refiners make and sell to the gas stations that we all travel to change as a result of the temperature. And the EPA demands that summer gas, which is more expensive to refine, is sold in order to reduce emissions because of the temperature. When the temperatures get cooler, refiners can produce cheaper gas because that ignites more quickly inside a typical combustion engine. So historically, winter gasoline prices have been cheaper in the summer because of that blend. So the fact that we're probably going to see demand hold down global crude prices and winter gasoline, which is a little bit cheaper, coming through into the stations, I would imagine we'll actually might get lower on gas between now and the end of the year, irrespective of today's blip.
Yeah, this next one's a bit of a strange story and maybe even stranger stock movement in the last 48 hours. But we have to talk about Beyond Meat as the company's COO's actions, altercations. There's lots of words to describe what happened there. Is it impacting the company's stock, Martin?
It is. The stock is down. It certainly was in pre-market trading. I haven't seen it in the last couple of moments, but basically the chief executive officer was suspended after a violent altercation over the weekend, which is a really bizarre story. It was outside the University of Arkansas's football stadium. Darren Ramsey is the COO. He is a former executive at Tyson Foods, which of course has really close ties to the state of Arkansas. He was, according to police reports, attending the football match, had an altercation with another driver as they were leaving the parking garage, and again, allegedly punched through the window and bit the other driver's nose. I'm not sure if I've ever been flown into a rage in which I would decide to take a bite out of someone's nasal cavity, but there you go. Beyond Meat wasn't really too excited about to hear this. They're in the middle of a turnaround, and they're trying, of course, to engender some positivity in their stock, which has taken a wallop this year as a result of food inflation prices. So they suspended the COO. It'll be interesting to see, obviously, and importantly, how this plays out from a legal perspective, because we don't want to castigate someone when we don't know the full facts. But Beyond Meat is taking no chances right now. They've suspended the COO, and that might last for some time.
To the point about volatility, I know we need to move on because it's rapid fire. The stock is actually currently up right now, Martin, over 11%. There was a big announcement with regards to Taco Bell, a collaboration to unveil plant-based carne asada. So, that had been the story, and you're exactly right. For the last couple of days, and pre-market pointed to exactly what you just said. And I said, hey, if you're invested right now in shares of Beyond Meat, BYND, the ticker symbol, good luck for whatever the hours or days ahead right now. Currently up 11%. Go figure. On to number 3 for the rapid fire we go. Let's talk GM. General Mills raised prices. Martin, did it work?
It seems to. They've had a really solid increase in their fiscal first quarter earnings. They were up about 3% to an adjusted $1.11 per share. They had I think it was 13% increase, 13% increase in earnings and a 4% increase in overall sales. They came in around 472 million, largely because they're able to exert price power in a market for food staples. You're talking about things like Cheerios, Lucky Charms, pet foods, snack foods, Betty Crocker cake mixes, just a really good, solid collection of staple brands that American consumers have been buying for decades now. And it's those kind of companies with pricing power that investors are most attracted to these days. So General Mills is going to get a pop as a result of these. They also had a pretty solid near-term outlook for organic sales growth that was up about 2 percentage points from their prior forecast. I see it growing by about 5 to 7% this year, and that's no mean feat in this kind of marketplace. But again, it is indicative of the fact that investors are looking for companies with pricing power, and those that have it will be rewarded, and those that do not are going to suffer.
Finally, Martin, I know where I'm going to be tonight. The answer is in the Bronx, left field. Aaron Judge slugged his 60th home run. What a game. What a game last night for both the Yankees and the Mets, by the way. The state of New York sports, dare I say, is very good right now. How many will he hit? What are you expecting from 99?
That's just 15 more games. Is that right, JD, that he has to break the record? You wouldn't bet against him. What's interesting to me about this guy is not only is he just a phenomenal athlete, but he really and truly does seem to be a team-first player. And obviously that's something that's very typical in baseball. But I think in this day and age, it's something that has probably increased his gravitas, not only on the team itself, but in terms of Major League Baseball itself and indeed the greater city of New York. I guess the larger question, DD, is now, if he does break the record, what is going to increase in value more? The ball that's hit into the stadium if he does so, or the value of his contract that he's expected to sign with the Yankees if he does? Because they're not going to let him go if he's an historic home run hitter, not in the capital of the sport. I just can't see that happening.
I mean, he's bringing Roger Maris back into the headlines, and rightfully so. Obviously, the chatter has been Judge might want to return home to California. Does he sign with the A's, the Giants, the Dodgers, so on and so forth? My buddy frantically texted me late last night after the walk-off hit from Giancarlo and says, Judge is going to do it tomorrow night in the Bronx. You and I are going, so I will bring an authentic first-person report, Martin, to tomorrow morning's broadcast to describe the energy of what I'm sure is going to be basically a sold-out house up in the Bronx tonight to see if 99 can do it. I always love talking all things sports and, of course, markets, with a really important day on tap later on from Jay Powell. We will be closely watching the 2 o'clock hour. The great Martin Baccardax, thank you for taking the time. Great to have you as always, my friend.
Thanks, JD.
Of course, that's going to do it for Opening Bell here from the floor of the New York Stock Exchange. Stick with the streets for more on these and every other major market story that mattered to you. Jay Powell later on today at 2 o'clock. We'll see you later.